Question number 3 is all about depreciation illustration, where I am going to solve this illustration under diminishing balance method. On 1st April 2010, Mrs. N.R. Sons Company purchased 4 machines for rupees 2,60,000 each. So we have multiple assets purchased during the year, and some of them may be sold the halfway through. So lots of assets are there, not one single asset. Now and then we'll purchase constantly some assets, and constantly some worn out assets could have been sold. In that case, how can you prepare the asset account? Yeah, of course, you can prepare the asset account directly, making small working note, or you can prepare the method of depreciation format for each and every asset independently. And then you group that group can be simply posted in the combined asset account. In both the way we can solve that. The first time I am going to solve this in this illustration. I am going to solve this under individual assets model. Each and every assets will be separately treated. And after that, I just straight away go for solving the illustration in a collective model, so that you will compare the difference between both the methods. Yeah, of course, both the methods will be accepted and you can get the mark, but the second method will be time consuming. So it means first method being the time consuming, second method being the time savings. So if you are being the professional students, your time allotted for the examination is very lesser. See, this illustration was asked in CMA Inter for 6 marks only. For 6 months, for 6 marks, hardly you can give around 7 to 8 minutes only. At the maximum 10 minutes. Within 10 minutes, you have to solve. But if you want to solve that for individual assets based model, then it takes lots of time. But for the beginning, at the time of understanding, you can work out under single asset model. Each and every assets are worked out individually. Assume that we have 4 machines purchased at rupees 2,60,000 each on 1st April 2010. So 1st April 2010, okay, original value 2,60,000. How many assets purchased? 4 assets. Again 2,60,000. Again 2,60,000. Again 2,60,000. 2,60,000. We have 4 assets purchased on the date. Asset 1, asset 2, asset 3, asset 4. And on 1st April 2011, this is the next year. So with that, the first year is over. So for the first year, you have to provide the depreciation. This is for first year. On 1st April 2011, the next year, the day 1 itself, 1 machine was sold for rupees 2,05,000 rupees. Out of the 4 assets, 1 asset seems to be unfit, so sold. This is for the second year adjustment. On 1st July 2012, okay, 1st July 2012, the second machine was destroyed by fire insurance. Claim received 1,75,000 on 15th July 2012. This will be the third year information. So first year we purchased 4 assets. In the second year, in the very first year itself, first day itself, we sold one of the unused assets. In the second year, one of the assets were lost in fire accident and was insured. So we received the insurance claim also on 15th July. So these are the 3 things happening in 3 different years. And a new machine costing 4.5 lakhs was also purchased in 1st October 2012. This is also happens only in the third year. Third year, 2 things happen. One is fire accident, and in order to replace the assets destroyed in fire accident, we purchased one more assets on 1st October. And the books are closed on 31st March every year. So year end will be 31st March every year. And depreciation has been charged at the rate of 15% per annum under diminishing balance method. So we have to provide the depreciation under diminishing balance method. You are required to prepare machinery account for 4 years till 31st March 2014. Now, year after year, I am going to work out that here. 1/1/2010. In 2010 and 11, the very first year, only purchases happens. There is no any other means a sale or additional purchases happen. For these assets, now I am going to provide the depreciation. Come on. So, year 2010 and 11. 2010 and 11, depreciation for the first year. 15 percentage at the rate of 15 percentage, that to WDV method. WDV method rate of depreciation is 15 percentage. 39,000. So very good. So start interacting with me by posting your answers in the chat box also, no problem. For all the four assets, the amount of depreciation being 39,000 rupees in the very first year. I'm solving this under WDV as well as I will solve that under SLM after, right? Okay. 260 and 39 and 31/3/2011. This is the WDV value. WDV value being 2,21,000. 2,21,000. 2,21,000 and 2,21,000. So first year is over. First year over. In the second year, the day one itself, one of the assets, I assume that the first asset sold. Okay. Sold for how much? 2,05,000. If any asset sold, it's better to have a separate working note for that. Okay. Whenever we sell any of the asset, you can work out separately. Now, as on 31/3/11, the WDV being 2,21,000. Is there any depreciation for the year of sale? No. The day one itself, the asset sold. As the asset sold in the day one itself, we won't provide any more depreciation for that year of sale. And as per my book, it is valued at rupees 2,21,000. But this one is sold for how much? 2,05,000 rupees. I sold it for 2,05,000 rupees. As per my book, the value of the asset being 221 but sold for 2,05,000. It means I lost. How much I lost? 16,000 rupees being the loss. Okay. This happens in year 1, year 2. Okay. Working note number. This is 1 and this is 2. Okay. This is all about for year 2. It happens in year 2. So hereafter, you never bother about the asset 1. Now we have to provide the depreciation for the remaining assets. So in the second year, 2011 and 12, we have only 3 assets. Out of the 4 assets, 1 asset was already sold. We have only 2, 3, 4. Only these 3 assets we have. For these 3 assets, we have to provide the depreciation for the second year. So for the year 2011 and 12, yeah, come on. What's the value? 33,150. 33,150 and 33,150. No other things happen in the year 11 and 12. So we have to subtract this depreciation for the year 2. After this, we'll get the WDV as on 31/3/12. WDV. The WDV here being 2,21,000 for the first year. What about the second year? 2,21,000 minus 33,150. The first one is nil, right? Sorry. Okay. This one is 1,87,850. Okay, 850. That remains constant for all other assets also. 1,87,850. 1,87,850. We got it now. 31st March 2012. Now, in the year 12 and 13, the third year, 2 things happened. One is one of the assets were destroyed in fire accident. Another one is purchase of a new asset. For the destroyed of the one of the assets, right, here is. On 1st July 2012, the second machine was destroyed by fire. An insurance claim was received 1,75,000 rupees on 15th July. I assume that the second asset is going to be lost. For this asset, I have to provide the depreciation as in the date of loss. So I'll skip this. This will be separately worked out. Number 2. Number 3. The value being 1,87,850. 1,87,850. What is this? This is the WDV as on 31/3/2012. Whenever we sell any of the assets up to the date of sale, you have to provide the depreciation. For this asset, the depreciation is provided as on 31st March only. This asset is sold on which date? or fire accident is happen on 1st July. So this particular asset is eligible for the 3 months depreciation, April, May, June. July 1st, right? So April, May, June, 3 months depreciation will be provided. Come on, get that. 7,044. Now the WDV or book value as on the date of fire accident being 1,80,806. 1,80,806. And this one is sold for, not sold for, insurance claim received for 1,75,000. We get less than its real worth. We thought it is 1,80,000, but we got only 170. We lose how much? 5,806 is the loss. See, whenever the asset is sold or destroyed, or if you want to dispose of from our books, from our usage, remove it properly and calculate it separately. So I have removed and calculating that separately here. So 1,75,000 and 5,806. This is the value. Now we don't have the second asset. In the same year, we purchased one more asset also on 1st October for rupees 4,50,000. So fifth asset is going to be purchased. Asset number 5. Asset number 5. The date of purchase being 1st October. 1st October 2012. The value of purchase being 4,50,000. The value of purchase being 4,50,000. Is that okay? Any doubts? So now we have to provide the depreciation for the year 2012 and 13. For this 1,87,000, 1,87,850. For that you have to calculate depreciation at the rate of 15%. The value being 28,000. 28,178. 28,178. In the case of lost asset, 4.5 lakhs into 15%, but was purchased only on 1st October. So from the 1st October to the year end, half year will be there. So you have to calculate the depreciation for the half year. So the value being 33,750. 33,750. Now after that, you will be getting what? WDV value. WDV value as on 31/3/2013. Okay. WDV. First asset is not there and second asset is also not there. Third assets, no. Okay. So the last assets being 4.5 lakhs minus 33,750, 4,16,250. So this will be 4,16,250 will be the value. And third and fourth, third and fourth is also there. The WDV of the third and fourth year as on the year beginning of the current year of accounting, 1,87,850, and depreciation for that year being 28,178. After that, the WDV being 1,59,672. 672. 1,59,672. Is that okay? We got it now. Now, we have to find out the next year depreciation. Depreciation for this is 13, right? This is 13. Now we have to calculate the depreciation for 2013 and 14 because we supposed to prepare up to how long? 4 years till 31st March 2014. So for the last year, we don't have any other adjustments. So directly claim the depreciation. First assets not there and second assets also not there. For the third assets, as per the book value, it is 1,59,672. For that 15% being 29,950. 951. So 23,951 and 23,951. And finally, the last assets 4,16,250. For that 15% will be calculated. That value being 62,438. Now the WD value by the time is for the last assets the 3,53,812 and 3 and 4. The asset 3 and 4 will be 1,59,672 minus 23,951, this value being 1 lakh 35,721, and fourth asset will also be valued at the same value, 1,35,721. Now take a total of this. Okay, this is the third year. Now I need to have the total here. Total here. Total of all the original assets, the very first 2,60,000 into 4. How much is that? 10 lakhs 40,000 rupees. 10 lakhs 40,000 rupees. And the next depreciation sum up of all these things, 1,56,000. If I subtract that 1,56,000, then I will be getting the WDV value. Yeah, how much is that? 8,84,000. And then depreciation for the second year, 3 depreciations are going to be clubbed. 99,450. 99,450. After subtracting the value being, yeah, come on, 884 minus 99.45. 7 lakhs 84. 7 lakhs. Okay, 7 lakhs 84,550. 550. And again, one more asset is also purchased, which is 4 lakhs 50. Now, depreciation for 12 and 13. No. 8 lakhs, 1 lakh is subtracted, means by default 7 lakhs. No, do the double calculations. And the depreciation for 12 and 13, 28,178 plus 33,750. This value being 90,106. 106. And then the WDV being, the WDV as on 31st March, 1,59,672, and 4,16,250 will be added. So this value being 7 lakhs 35,594. 594. The depreciation for the last year, 23,951 for 2 years, 2 assets, and 62,438. This value being 1,10,000. 1,10,340. Okay, if I subtract that value from 7,35,594, then the WDV value for all the assets exist as on the last year, 6,25,254. So I have worked out the depreciation and WDV for each and every assets individually. This will be an extensive working note. Then I will work out the same illustration without working the so lengthy process, so that we'll get the answer easily. Now let's solve this illustration or post that in the ledger. So I am going to prepare the ledger here, asset account. Asset account, let's see. Asset account. Now, hereafter it's very simple. Asset account. Asset account. Very first, on this date, I am purchasing an asset for 10,40,000 rupees. So, 1,410 asset account debit to bank. The value being 10,40,000. 10,40,000. And depreciation by the year end, for that year, calculated by the year end, 31/3/2011, depreciation, this value being 1,56,000. No more adjustment is there. So 10,40,000 and 10 lakhs 40,000. The balance carried on was also already available, 8 lakhs 84,000. So simple, 8 lakhs 84,000. Rewrite here 1411. Balance brought down 8 lakhs 84,000. 8 lakhs 84,000. And depreciation in the second year, one asset is also sold, then automatically these information is also going to be incorporated. Sold for 2 lakhs 5,000 on the year beginning. The sale date is 1411. Bank, the amount collected by selling the asset being 2 lakhs 5,000. And because of this sale, we lose 16,000. That reduces the value of the asset. So I put the value in the credit side, loss on sale, the value being 16,000. Remember, from the 884, if I subtract these two, whatever the balance I get, that balance is nothing but balance of all the existing assets before the depreciation. Before the depreciation. On that also you can directly calculate the depreciation. See that 8 lakhs 84,000 minus 2 lakhs 21,000. For that, if you calculate 15%, that amount of depreciation should be 99,450. Cross verify that. So for the year end 31/3/12, depreciation for all the existing assets 99,450. 99,450. If I tally this, I will get the balance again. 8 lakhs 84,000. 8 lakhs 84,000. And then the balance carried on here being balance carried on. Also, we have already found out that 7 lakhs 84 550. 7 lakhs 84 550. Now, go to the next year. 1/4/13. Balance brought down, the value being 7 lakhs 84,550. We are in the third year. In the third year, what happens? This will be incorporated. Working note number 3, where one of the assets was destroyed. The treatment for any fire accident or theft or sale will be the same. Here also one of the assets, in the year beginning, it is valued at rupees 1,87,850. Is subject to depreciation for the current year being 7,044. 7,044. After this depreciation, we thought it is worth rupees 1,80,806. Sold for, not sold for. Amount realized by insurance company is 1,75,000. Balance will be the loss. I am going to post that here. As on the date of fire accident, the fire accident happens on 1st July 13. On the date, depreciation will be charged separately. This is nothing but the depreciation of the asset sold up to the date of sale. Number 1. The earlier year, we sold in the year beginning itself, so we don't have any unadjusted depreciation for that second year. But in the third year, the asset was used for a couple of months, around 3 months already used. So we have to provide the depreciation for the 3 months first of all, and whatever the balance left over, compare with the sale price to determine if there is any profit or loss. Of course, there is really loss also. And the 1,75,000 rupees is nothing but insurance claim received. The due date, the thing happened on 1st July, but the amount realized later, probably 15 days later. So we can pass a due entry, insurance claim account debit, like rather than bank account, we can pass the entry as insurance claim. We collect that money when 15 days later, right? So as we collect the money 15 days later, by the time bank to insurance claim, that's how you can pass to entry, or you can directly post here, omitting that one. On 15th, we collect the bank. That way also it will work. Okay. Wait. This balance, wait. 8 lakhs 84,000 minus 99,450. Okay. Then add 450. Okay. Now we'll get this balance, right? Okay, once again I'll correct here. Tell me what's the value? 5 lakhs? Yeah. 5 lakhs 60. Ah, 550. Okay, I'll stand corrected here. This value is now corrected. Okay. 5 lakhs 63,550. 550. So this opening balance being 5 lakhs 63,550. Okay. Okay then. Okay then. Is that clear? Don't do subtraction. Addition. It's only addition. So we have to add these three to get this value. Don't subtract 99,450 from 8 lakhs 84 to arrive this, because there is one of the assets sold. That value is eliminated. No. Was removed? No. So it's better do this way. Additions of all this column. So here the insurance claim amount received being how much? Insurance claim 7 lakhs 1,75,000. We received that insurance claim less than what we expected, what our book value shows. So that will be loss. So that will be now loss on sale, loss on fire accident. The value being 5,806. And what happens? Any more thing happen in the third year? Of course, in the third year we purchased one more asset for 4,50,000. The date of purchase being 1st October. So on 1st October 2013, bank, the value here being 4 lakhs 50. Now we can tally this. If I tally this, 10 lakhs 13,550, and we have to provide the depreciation for the third year. The depreciation provided for the year 12 and 13 being 90,106. 90,106. This is the depreciation. After that, if I tally 10 lakhs 13,550, the balance I will get by this time being 7 lakhs 35,594. Hope so you could understand. And for the next year, 1/4 to 2014. Okay, 2000 started with this is 12, I think so, right? This is 12. Ends with 31 3 13. So I start with 1/4/2013. Balance brought down being 7 lakhs 35,594. Now the depreciation for these assets for the year 13 and 14, claimable or chargeable only in the year end 31/3/2014. Depreciation, no more purchases and sales happens in the fourth year. Only depreciation is provided, which is 1,10,340. If I tally this, so this value being 7 lakhs 35,594. 7 lakhs 35,594. Then you will get the balance. The balance being 6 lakhs 25,254. And carry on to the next year, beginning 1/4/14, 6 lakhs 25,254. We supposed to prepare only for these 4 years. You no need to carry on further. Is that clear? Yes, come on, make a note of it.